Today, we will talk about the applicable federal rate, AFR, and how it's used to determine the minimum interest rate for private loans. The applicable federal rate is the minimum interest rate that the IRS allows for private loans. Each month, the IRS publishes a set of interest rates that are considered the minimum market rate for loans. Any interest rate that is less than the AFR would have tax implications. The IRS publishes these rates in accordance with Section 1274(d) of the Internal Revenue Code. The AFR is used by the IRS as a point of comparison versus the interest on loans between related parties, such as family members. The IRS publishes 3 AFRs, short-term, mid-term, and long-term, based on the maturities of marketable obligations. These AFR rates are used to determine original issue discount, unstated interest, gift tax, and income tax consequences of below-market loans. The length of time designated for payback determines which AFR rate to use for a family loan. Let's say you were giving a loan to a family member for $10,000 to be paid back in 1 year. You would need to charge the borrower a minimum interest rate of 4.3% for the loan. Any interest rate charged below the stated AFR for the particular term of the loan would be considered foregone interest and, as a result, be taxable. When preparing to make a loan between related parties, taxpayers should consider the length of the loan and the proper AFR. If the lender charges interest at a lower rate than the proper AFR, the IRS may reassess the lender and add imputed interest to the income to reflect the AFR rather than the actual amount paid by the borrower. Also, if the loan is more than the annual gift tax exclusion, it may trigger a taxable event, and income taxes may be owed. Depending on the circumstances, the IRS may also assess penalties. No, you're not required to charge interest. However, by not doing so, the IRS may consider your loan a gift and levy taxes accordingly. Here are 3 key takeaways. 1. If the interest on a loan is lower than the applicable AFR, it may result in a taxable event for the parties involved. 2. AFRs are used to determine the original issue discount, unstated interest, gift tax, and income tax consequences of below-market loans. 3. Parties must use the AFR that is published by the IRS at the time when the lender initially makes the loan. Hope this would help. Thanks for watching.